All right, I am going to get started. Good afternoon, folks. My name is Ed Jameson, coming to you from rainy Boston. And today we're going to talk about indirect rates. Before we get going, I'd just like to introduce myself. I'm a 53-year-old man who's been doing this for 39 years. So I'm going to let you do the math in your head. When I was 14 years old, my dad came home from work one day, sat the family down and said he'd lost his job. Wasn't sure how he was going to put food on the table, but he was going to start his own accounting firm. And as a 14-year-old kid, I said to my father, "Dad, I like to eat, so if there's anything I can do to help, let me know." What I didn't realize was that my father had been a government contract accountant. He had worked for the Honeywell Electro-Optics Division, iTech, Laboratory for Electronics, all government contractors. So in addition to the normal tax and accounting CPA firm, we had a number of clients who did business with the federal government. So at age 14, my dad taught me how to reconcile bank statements. By the age of 16, I was preparing corporate tax returns. By the age of 18, I had about a $40,000 book of business of pizza shops, canteen trucks, hair salons, anything to make a buck. I did it. What I didn't really appreciate was that we had 5 or 6 clients. Some of them were involved in the Strategic Defense Initiative, Star Wars, and I was exposed to the Defense Contract Audit Agency, DCMAO, and got all sorts of information about sort of the inner workings of the federal government by being mentored by my dad from a very young age. Probably 15 years ago, I bought my dad out. He's now retired out in the Outer Banks of North Carolina. And we focus our efforts solely on government contractors and grantees. We've got about 150 clients across the country in about 27 states. We deal with literally every federal government agency, every different type of award. Most people are familiar with the Small Business Innovative Research Program, the SBIR, STTR program. It gets us great Google results, so we like to throw it in the title. But if anybody has an ARPA-E or a BAA or a BARDA or an RO1, we're happy to talk about those as well, because those are all cost reimbursable type awards. And we're going to talk about what that means in our next screen, I think. So today's agenda, we're going to talk about flexibly priced government funding vehicles. And what that means is it's not fixed price. So most of the Department of Defense Phase 1 SBIRs are fixed price contracts, but most of the Phase 2 awards are cost reimbursable type awards. Literally all of the NIH grants are cost reimbursable grants. Most of the Department of Energy grants are cost reimbursable. So today we're going to talk about flexibly priced government funding vehicles. We're going to talk about what your strategy is when you're applying for those vehicles. I'm going to teach you a concept that is known as the multiplier. So if you don't know what your multiplier is, you're going to be speaking a little bit of a new lingo within an hour. I'm going to talk about how the government views indirect rates. We're going to talk about what indirect rates are used for. I'm going to ask a very serious question for a lot of you. The question is, do you have a project or a business? It's really, you can't have a business until you have a successful project or two. So I don't want you to think I'm asking you an insulting question when I ask you that question, but when you start to transition from a project to a business, you must get this right or your business will fail. And then finally, we're going to close talking about safe rates and how safe they are exactly. I get a lot of people asking me about safe rates, so I like to throw that in there. So the entire reason our firm exists is because of Federal Acquisition Reg, or FAR, Clause 52.216-7, which is known as the Allowable Cost and Payment Clause. If you see this clause in your award, it means you have a cost reimbursable type award, which means the federal government will reimburse you for your reasonable costs, both direct and indirect, and there'll probably be some sort of a fee. It may be a little bit difficult to figure out whether you have this. I mean, if you have a DOD award, typically you've got a 30, 40-page award, and there's 2 pages of FAR clauses, and FAR clause 52.216-7 will be very clearly spelled out. In a notice of grant award, it will come with terms and conditions. When you click on the hyperlink, it'll drive you into a several hundred-page document that will have 5 or 10 hyperlinks on every page, driving you into tens of thousands of pages. You're going to have to take my word for it. Your NIH grant is a cost reimbursable type award. All ARPA-E awards are cost reimbursable. RO1s, broad agency announcements, and BARDA awards are typically cost reimbursable awards. So that's when you need a Greek CPA. And I use the word Greek because most of the time when I tell people I'm a CPA, they immediately think, oh, you do taxes, how was your busy season? And I say to them, well, that's not really the kind of accountant I am. I mean, we speak Spanish, we do corporate tax work. We're also, all of our senior people are all CPAs, so we're very fluent in French. We're all very familiar with generally accepted accounting principles. But what makes our firm unique is we speak Greek, this very special language known as the Federal Acquisition Regulations. Each agency also has the right to issue their own supplemental regulations, and they do. So there are, in addition to the Federal Acquisition Regulations and the cost accounting standards, there are DOD supplemental regs, NIH supplemental regs, DOE supplemental regs. So a lot of times you're dealing with a multi-layered cake, but I'm not trying to make this more complicated. I'm trying to make it simple. So let's go to our frequently asked SBIR question. We are in a business incubator and wanted to put as much money as possible into the scientific project, so we did not ask for fee, overhead, or fringe benefits. We intend to develop a commercial product, and the strategy seemed to work well for getting our project's initial funding. Will this decision affect future grants? So we see this and several variants of this all the time. People walk into our office with 7% overhead rates, 10% overhead rates. We ask them how they came up with the number. They kind of look at us cross-eyed. Somebody at MIT told me to use this or use a rate lower than this. So what I want to do today is get you comfortable with what exactly it is we're talking about. Before we do anything, though, I want you to think about this in context of your strategy, your business development strategy. So how are you going to use government funding to develop your business? Is it going to be an integral part of your business, or is it going to be used so that you can have the government's good housekeeping seal of approval? The other key question that I ask people to think about is, are you bootstrapped or VC backed? So if you're bootstrapped, this next hour is going to be critically important to you because every dollar in and out is going to be predicated on you understanding and managing your indirect rates. If you're VC backed, most VCs look at this as an extra $1 million that they don't have to come up with if you wind up getting an SBIR phase 2. They don't particularly care whether it gets charged to direct or indirect. It's just $1 million they didn't have to come up with. So we see two very different types of thinking, and this webinar is really geared more towards somebody who's bootstrapped and who really needs to understand kind of, because every dollar is at risk. So a lot of times I ask people this question and I really don't get a good answer. So I'm going to tell you what indirect rates are used for. Indirect rates give you the money to build your business infrastructure. It allows you to hire people, create facilities and processes, and allows you to work on the business. And I'm going to use this word very carefully. I talk about working in your project and working on your business. So I really want you to hear that distinction, especially when I start asking the question whether you have a project or a business. Because if you have a project, you tend to be working in the project in technical terms, doing engineering type stuff. That's very different from working on your business, hiring people, renting facilities, building processes. It's a very different mindset shift. So before we go much further, it's really important to start to draw the distinction that the government wants you to draw. So the most important question in this webinar is is this cost a direct cost, an indirect cost, or an unallowable cost? Now, an unallowable cost is a cost that the federal government won't reimburse you for. They're specifically unallowable in the federal acquisition regs. So if you and I go to lunch and we have a beer, there is no intrinsic benefit to the government of us having a beer. Those alcoholic beverages are unallowable. I have a bad back, so I like to fly first class. The government thinks it's appropriate for me to fly coach. The difference between my coach ticket price and my first class ticket price is an unallowable travel expense, right? So one of the questions that I get all the time when I speak is, Ed, how do I deal with this expense that wasn't in the initial proposal? And I will tell everybody in the audience, I have never in my 39 years met anyone, and I meet a lot of really brilliant people. I've never met anybody brilliant enough to be able to write a proposal for something that they're going to be doing 6 to 12 months from now and have them project exactly correctly exactly what the costs of running that project are going to be. I've never seen it happen. So when you incur an expense, whether you proposed it or not, the key question is, does the government benefit from it or not? And is that cost a direct result of this project, or does it indirectly benefit the entire business? And that's really the litmus test that you have to go through with every cost. So the first specific example I have is a lab jacket. Now, I did a talk for the Principal Investigators Association a couple of years ago, and I got a call about a week, 4 or 5 days later, from a gentleman who asked me whether a lab jacket was a direct cost or an indirect cost. And my brain immediately sort of went to, what is a lab jacket? It's a white jacket that people wear. It protects their clothing during their experiments. It's used typically all day, so, quote, all of the projects would benefit, so it's probably an indirect expense. But rather than answer that question, I asked the gentleman, why do you ask the question? And he said, well, Ed, and he was from Texas. I'm going to do my terrible Texas accent. He said, well, Ed, we do this one particular bovine experiment, and when we do, we tend to ruin our lab jackets. And I said, oh, in your case, lab jackets are a direct expense of that project, because if it weren't for that project, you wouldn't have to continue to buy more lab jackets. So one of the key points that I want to make here is, just because it's an indirect cost for somebody else doesn't mean it's an indirect cost for you. Just because it's a direct cost for somebody else doesn't mean it's a direct cost for you. What matters is your business and how your business works. So nobody can dictate to you how your overhead structure should work. Your job is to figure out how to fairly allocate the costs of running your business to everybody who benefits from it. And everybody who benefits from it is government project A, government project B, and commercial project C. So what you're looking for is a fair and equitable way to share the overhead costs of running your business. Now, when it comes to employee benefits, we see the gamut. We have clients who offer very little in ways of employee benefits, and we have clients in Silicon Valley who have fringe benefit rates that are in the 40s because they're competing against Google for employees. And Google picks up their employees in a bus, drives them to work, feeds them, does their dry cleaning, and drives them home. And in order to compete with Google for employees, they have to offer very generous benefit packages. People in other states we work with don't have to be as generous, and they're prudent business people who would rather spend their money on other things. So really this becomes a question of prudence. So just because something is allowable doesn't mean it's necessary. And the government doesn't want you to spend money unnecessarily. So one of the thoughts that comes through my mind here is rent. So I've walked into facilities where my client has 10,000 square feet of space and they're using 2,000 square feet and 8,000 square feet sits idle. That's really a waste of money, and if a government auditor ever walked in the door, they would say, boy, I'm going to disallow that 8,000 square feet of rent because it's just not a prudent spend of money. But typically, rent is an arm's length transaction between a business owner and a landlord, and typically your rent expenses are an allowable expense. They typically are for your entire business, and it's the kind of expense that gets shared by all of your projects. However, I have some clients who have specialized facilities where only certain projects benefit from those facilities, and they create separate cost pools. Now, I'm a huge advocate for simplicity. So realistically, there are 5 most common ways of recovering your indirect rates. We see DoD contractors with overhead rates. We see DoD contractors with overhead and G&A rates. And we see DoD contractors with fringe overhead and G&A rates. So they either have a 1-pool, a 2-pool, or a 3-pooled methodology. Now, some of my larger clients start to get into these specialized facilities. They may have facilities on a government base and other facilities off the government base. So as the business develops, you may be forced to have a more complicated indirect rate recovery methodology, but we are huge advocates for keeping things as simple as possible at first. So typically, rent is an allowable expense. But what if you're the landlord? So if you're the landlord, you're reaching a lease agreement with yourself. So that's not taking place at an arm's length, and therefore the government looks at that and says, okay, what's the true equitable value of what's going on there? So even some of the most basic things are not as clear-cut as they seem. It's always case by case. Now, one of my favorite things to bring up is whether the accountants and lawyers are recoverable costs. So when you hire Jameson and Company, we are a 100% recoverable cost. If you want me to do your personal tax return, number one, I won't do it, and number two, it benefits the government not, therefore it is not an allowable expense. But typically, most accountants' costs are allowable expenses. With lawyers, however, you have to look at what the lawyer is doing for you. So if you're raising VC money, you're effectively bringing in money to change the ownership structure of the firm, of your business, and the government says, we're not sure how we benefited, whether you own the firm or you and Roger own the firm. Therefore, those costs are unallowable because they're really considered reorganization costs. If you have to bring in a foreign worker, I know there's Hire American Acts. I know the Trump administration is very big on Hire America Acts, but let's assume that you've gone through every effort you can to hire an American worker, and one with the skill set you need just doesn't exist. Because the government benefits from you sponsoring a foreign person to perform these tasks, that is an allowable cost. Now, the government may change that at some point in the future, but that's the way the rule reads right now. Now, patent costs are an interesting one. I think we got a few questions with those on some of our preceded questions. In a nutshell, the National Institutes of Health see patent costs as a commercial expense and therefore treat it as an unallowable expense. The Department of Defense thinks patent costs are typically normal, ordinary, and necessary as long as you're doing business in the countries in which you're filing those patent filings. So, sorry to make a seemingly simple subject as complicated as possible, but that sometimes is what happens. So let's talk now that we understand the distinction between a direct and an indirect expense. Let's talk about the balancing act that is projecting and managing your indirect rates. And it's one that we see most people getting wrong, and most people dramatically underestimate what the real indirect rates are that they need to run their business. And how do they do that? Well, what they do is what we call working backwards. And what does that mean? What it means is, oh my gosh, we're going to propose on a phase 2 SBIR, and this is a super duper SBIR, so we know that the total award is going to be $1.5 million. And I've heard that you can get a 7% fee, so if I divide 1.5 million by 1.07, I know that my total costs need to be $1.4 million, and I'm going to get $100,000 for fee. And then we know that we're going to need prominent consultant number 1 and prominent consultant number 2. We're going to have to subcontract a lot of this work to Johns Hopkins or MIT or Cal Poly. We're going to spend a couple of $100,000 for materials. And then we've got some people, and Joe's going to spend, 30% of his effort here, and Sally's going to spend 50% of her effort on here. And at some level, the fringe benefit number and the indirect cost number become plugs because I've got a finite pool of money, $1.5 million. Now, let me explain what the multiplier is. The multiplier is a concept that basically says, if I pay $1 for labor, how much do I charge the federal government? So in this example, this contractor has an overhead rate and a G&A rate, and they're using 100% overhead rate and a 25% G&A rate. So they pay $1 for labor, they add $1 for overhead, they take that subtotal and they add 25% for their general and administrative costs. So now they're up to $2.50. They add their 7% fee and they charge the government $2.68. So for every dollar that they pay labor, they charge the government $2.68. This is known as your multiplier. Now, we've been doing this for a long time, and nobody in the federal government will ever come out and publish this information. But what happens is we have conversations with our clients, and we ask them questions like, when you propose these indirect rates, did your customer say anything? Did they provide any level of pushback? So these numbers that I'm showing you right now, this overview, this is our experience with DOD type SBIR government contractors. This is very different from people who are at Wright-Patterson Air Force Base who are competing on the base for contracts. The SBIR program is the least price-sensitive program in the government. It is like I call it the Make-A-Wish program, right? I wish I had a cure for cancer. I wish I had a missile that did certain things. I wish. And at some level, if you can come up with an innovative, brilliant, technical new way to do something, the government wants to hear about it. So they're not real excited about cost as much as they're excited about how great your idea is. So in that backdrop, when we ask our clients whose multipliers were less than 2.4, they basically tell us, nobody ever talked about our indirect rates, which is an indication that they're seen as inexpensive. When their multiplier ran between 2.4 and 2.7, there was a normal discussion, a normal business discussion about pricing and indirect rates. When their multiplier started to get between 2.7 and 3, the customer started groaning about how, quote, expensive the contractor was. And we see situations where at above a multiplier of 3, the government just says, this is ridiculous, we're not paying for this, and walks away. Now, I have a client in White Plains, New York, who makes cryogenically cooled microprocessing chips. They have their own foundry, and their multiplier is more than 3, and the government funds them all the time because what they have is so novel and so unique and so valuable that the government doesn't find their particular application to be prohibitive. So without knowing your business and the kind of competitive environment that you're in, it's very difficult for me to give you any sort of advice unless I'm working with you. But these are just rules of thumb, and it makes most people's jaws drop because their multiplier is typically nowhere near that. Now, the National Institutes of Health typically pool costs differently. They're going to encourage you to have a fringe benefit rate and what's known as a finance and admin rate. To get to that same pre-fee multiplier of 2.5, you'd have to have a fringe benefit rate of 35% and an F&A rate of 85%, which is pretty high. I mean, it's staggeringly high. I want to tell you, MIT, Stanford, Harvard, their F&A rates are like in the 60s. But we've had clients in Kendall Square, we've had clients in Sunnyvale who've had F&A rates that are triple digits. It's reasonable, it was ordinary, it was necessary, the government reimbursed them. Typically, we see NIH fringe rates run between 28 and 42%, again, depending on what you have to do to hire and attract employees. And F&A rates that get negotiated tend to be between 55 and 70%. That's kind of normal in that environment. And part of the reason for that is because your indirect expenses are divided by your total costs. That's the definition of how to come up with an F&A rate, where your overhead rate is your indirect expenses divided by direct labor only. So F&A rates tend to be lower than overhead rates just because of what goes into the makeup of the numerator and denominator. So one of the most important things that you have to factor into all of this is how are your expensive people going to spend their time? So if you wanted, I could show you very easily how to manipulate your indirect rates. And basically what I would show you is if you want to keep your indirect rates really low, have your expensive people charge all their time direct on a project. If you want your indirect rates to be high, have all of your expensive people charging their time building strategic alliances, diversifying the revenue stream, and advancing the technology. Those types of indirect labor will drive your overhead rate. And those are exactly the types of things that happen when your project turns into a business. Your expensive people stop working in the business and start working on the business. So it's a very big difference that happens as your project morphs into a business. And anybody out there who's like got a business, you know, employees, 10% of their time is vacation, holiday, and sick time. So you know you have a business when you're paying somebody not to show up to work. So let's go back and take a look at our working backwards mindset. So remember a while ago we showed us plugging these indirect costs and these fringe benefit pools. If you do the math, you've got a 16.7% F&A rate and a 17.6% fringe rate for a total multiplier of 1.37. Taken in context, it's a ridiculously low indirect rate to run a business. Now, it might be perfectly adequate for you to run your project, especially if you're in an incubator or if you're being subsidized by a VC. That's, again, why I tell you strategically think about how you're going to use government funding. Because once you establish these patterns and then you come in with something wildly different, guess what the government says? Well, last time you came in and you proposed a 16.7% overhead rate. Now you're proposing a 75% overhead rate. What happened? Oh, I got a clue what I was doing. I mean, so you really want to think about this, especially when you're getting ready to sit down and write a phase 2, an ARPA-E, an RO1, a BAA, or a BIR award. So indirect rates that are too low automatically create cash flow problems and project cost losses proportional to the degree of the miss. So in our prior example, if our actual indirect rates ran at 46% and we proposed at 16%, we would automatically, just mathematically, lose 30% on this project. So if you're bootstrapped, what do you think happens? You wind up borrowing money, diluting yourself, getting yourself into trouble, firing people at the first funding hiccup you get. It really hampers your growth. So I want you to think about for a minute now, most people will tell me, geez, I'm afraid to use a higher indirect rate because this is wicked competitive and I don't want to appear to be uncompetitive. And the government, for whatever people say about them, they're not stupid people. So if you were a procuring officer and somebody came in and there was a $1.5 million pool of money, and a contractor came in and had an irrationally low indirect cost recovery system, and another one came in with a rational cost recovery system, which one has less risk? The one where the guy's probably going to go bankrupt, or the one where the guy's probably going to be able to continue an ongoing business? This comes down to, do you understand the difference between a direct and indirect and an unallowable cost? Are you doing things in a prudent manner, and are you accounting for things properly? The government wants to reimburse you for your reasonable, allowable costs. They don't want to see you go bankrupt. Competing for government funding is very competitive. I'm hoping you have something novel and innovative that you're proposing to the federal government, because if you're not, you should do something else with your time. And I don't mean to be crass about it. it's incredibly competitive. But if you've got a business and you need certain indirect rates to run your business, you need certain indirect rates to run your business. And the government understands that. So let's talk for a minute about safe rates. So the National Institute of Health will allow you to take a 40% F&A rate for a phase 1, and they will allow you 40% or less on a phase 2, no questions asked. Now, if you want a 45, a 50, a 60% F&A rate, you have to basically check a box that says, audit me. Now, I don't know too many new business owners who want to check a box that says, audit me, but that's effectively what the National Institutes of Health ask you to do. The National Science Foundation will allow you to use a 50% indirect rate based on direct labor costs, which, although 50 is bigger than 40, typically direct labor as a component of total direct costs, this is a much more favorable indirect recovery number than this one because of the base. So you've got to think numerator, denominator. So in the denominator for NIH, you've got all direct costs, consultants, subcontractors, travel, materials, labor. With NSF, you've got labor only. So I'm going to now teach you, a new NIH grantee, how to commit what I call inadvertent fraud. And I call it inadvertent because fraud sounds so nasty, and you probably didn't know you were committing it, and fraud tends to be more purposeful. But let me explain how the National Institutes of Health work. With DOD, when you propose a phase 2, the Defense Contract Audit Agency will come out before you get the award and do what's known as a pre-award audit, and they will take a look at your accounting system to make sure that your accounting system is set up to capture job costs as direct, indirect, and unallowable. And they will look at the indirect rate that you projected when you did your proposal and say, how did you come up with these numbers? With the National Institutes of Health, if you use a rate of 40% or less, you do not negotiate an indirect rate. The Division of Financial Advisory Services does not get involved. The grant management, the grant specialist typically says, oh, a 25% F&A rate. They rubber stamp you and you move on to the next process. So again, DOD, step 2, they're reviewing your accounting system to make sure that you're accounting for direct, indirect, and unallowable costs properly. With NIH, they basically say, send me a copy of your chart of accounts, which you can download off their website, and send me a copy of your timesheets, which, again, you can download off their website. So if you send a grant specialist 2 forms that you can download off their website, you are deemed to have an acceptable accounting system. Then what happens is, and this is where it gets really interesting, with DOD, you do a month's worth of work, you submit a bill, and you wait to get paid. With NIH, let's pretend you get $1.5 million phase 2, and the first year's funding is $750,000. That $750,000 immediately gets sent to the payment management system. So there's $750,000 effectively sitting in the cloud waiting for you to grab it. They will give you a login name and password. You go in and you type $37,422.75, and the next day that exact amount of funding shows up in your bank account. In fact, as long as you don't draw more than once a day, you can just bang that money right down. Now, the problem is you're only supposed to draw down money as you earn it. And the form I'm going to show you on the next page is something that they ask you to do on a quarterly basis. Now, you're only supposed to draw down funds that you've earned. Now, if you don't negotiate your indirect rates are capped at whatever you used in the proposal. So if you wrote 40%, your indirect rate is capped at 40%. If you wrote 5%, your indirect rate is capped at 5%. If you wrote 0, your indirect rates are capped at 0. So if you draw $1 for an indirect expense and you didn't propose any indirect expenses, you are now illegally drawing down funds. On the flip side of it, if your actual spending is 20% and you've used a 40% indirect rate and you're drawing money down at a 40% clip, you're drawing down 20% more than you're entitled to. So in either case, you're drawing down money illegally. And when you go to file the SF-425, the Federal Financial Reporting Form, I want you to stare at line 13 very carefully. It says, by signing this report, I certify that it is true, complete, and accurate to the best of my knowledge. I am aware that any false, fictitious, or fraudulent information may subject me to criminal, civil, or administrative penalties. University of Houston professors, 2014 indictment. 1 count of conspiracy, 7 counts of making false statements, 21 counts of wire fraud, all in connection with the SBIR program. According to the indictment, both men started Integrated Microsensors, a small business which applied for and received SBIR grants or contracts from NASA, NSF, Department of Energy, and the U.S. Air Force. These 2 men were convicted and sentenced to a year in jail. There is a Washington State professor that was recently indicted. Folks, if you overbill the government, they do not take kindly to that. So in summary, most people propose indirect rates that are too low and bake in cash flow problems and financial losses. If you don't get this right when your project turns into a business, this can be game ending. But if you do this properly, cost type work is a beautiful way to help you build your business infrastructure, your people, your facilities, and your processes to help get your business to the next level. The government wants you to succeed. They want you to help them solve their problems, and you can't help them solve their problems if you go out of business. So how do we typically work with our clients? We usually supplement your existing financial team. Now, some of our clients don't have a financial team. Some of our clients have various levels of financial teams. But what we typically do is we help people with their indirect cost rate development. We will handle the financial negotiations with government officials. We'll help clients set up their accounting system, give them training, and provide periodic oversight to make sure that their systems are in compliance. If you have a cost reimbursable award, once a year you are required to prepare what's called an incurred cost submission, where you effectively true up between the actual spending and the money that you've billed the government. We will prepare that incurred cost submission and represent you during the government audit of that submission. And we also, want to make sure that you understand one of these, what kind of things are going on inside my business where it might make sense to pick up the phone and call Jameson. So if you're filling out the cost portion of your proposal and you're not sure, especially when it comes to indirect rates, give us a buzz. If you're not realizing a 7% profit on your SBIR grants and contracts, give us a buzz. If you're having cash flow problems, unexpected debt, or dilution events, it typically means you're overrunning your indirect rates. Good time to give us a buzz. If you're having problems getting paid, if you don't know what your actual overhead rate is, people ask me all the time, Ed, am I okay? And the first question I ask them is, do you know what your overhead rate's running right now? 90% of the people I ask that question to can't tell me what their overhead rate is running. Guess what I tell them? There's a pretty good chance you don't have an acceptable accounting system if you don't know how your indirect rates are actually running. If you have concerns when you're signing that FFR, if you have concerns about your existing financial team, give us a buzz. We've got some introductory products that we sell. So the first one is, I have an existing accounting system and I'm not sure whether it's okay or not. We do something called a risk and compliance analysis. If you say, I don't even have an accounting system, I need you to help me set one up, we have what's called a phase 1 survival kit, where we literally set up your QuickBooks chart of accounts, we give you some training, and we help you get the systems in place. If you're just getting ready to write a phase 2 or a cost proposal, we have indirect rate projection templates. We'll help you develop those indirect rates and help you with the cost portion of the proposal. So those are some real nice introductory products that we have. They're all money back guaranteed. We've been in business for 39 years because we're trying to help. If you have any questions, I'm going to let you reach out to Katie Crowley. I've got some time and I've got half a dozen questions. So I'm going to try to get through as many of these as I can. And I'm going to start with Donna, and I'm going to unmute Donna W. Donna, this is Ed Jameson. Can you hear me? Donna Williams. Donna's got her hand up. Donna, can you unmute yourself? I've unmuted you. Can you hear me? Can you talk to me? All right. Well, I don't know that Donna can hear me, but let me read you Donna's question. Donna says, do the FAR regulations on unallowable costs cover the SBIR fee as well, since it is neither a direct or indirect cost category? In particular, can it be used to pay for patent expenses? Donna, that's exactly what most of our clients do with their profit on their government awards. They use it to pay for unallowable expenses, whether it's alcoholic beverages or unallowable patent costs. You can use your 7% profit, or 8 or 10 or whatever you negotiate. You can use your profits on anything you want. You're not attempting to recover that through your indirect expenses, so you can spend it on anything you want as long as it's, legal. Her follow-up question is, are legal fees for assessing intellectual property and trade name availability an allowable cost? They actually are. So again, Donna's not talking about, I'm paying my patent attorney to draw the final artwork and claims and process the patent. Basically what she's asking is, I want my lawyer to do a patent infringement review and make sure that we're not infringing on anybody else's technology. So your initial trademark and any patent infringement reviews are an allowable expense. Now, Donna, I will advise you, when your lawyer sends a bill, ask them to give it to you in detail so that you can carve out the pieces that are allowable and the pieces that are unallowable. So hopefully that answers your question. I'm going to go on to Blythe. Let's see if Blythe is here. Blythe is not here. Blythe wanted more education on direct and indirect costs, so because she's not here, I'm not sure what exactly her questions were. Let's see if Leonard is here. Leonard is here. Leonard Mack, can you hear me? Leonard McCreary, are you there? All right, so I can, oh, Leonard, there you are. How are you today?
Excellent. How are you, Ed?
Good, thanks. So I've got a couple of questions here, and then let's see if I answer the questions, and I'll let you continue to ask questions if I don't answer them. So Leonard's question is, what is the best cost pool structure for an SBIR company? Now, Leonard, I'm going to tell you, it's different for everyone. So it's whatever makes the most sense for your business, but the goal is for you to find a way to fairly share the overhead costs of running your business with all of your clients. So there's 5 typical common ways to do that. There's the overhead rate, there's the overhead and G&A rate. Fringe overhead and G&A rate tends to be DOD-centric. NIH and granting tends to be fringe and F&A rate or fringe and modified F&A rate. What we tend to see is as our clients grow and become more sophisticated, some will wind up with on-site and off-site overhead rates. They may have material and handling rates. They may have separate facilities, pools, but typically when you get started, you want to have as simple an indirect cost recovery system as possible. So does that answer your question? Because you've got some other questions here. How are the pool rates multiplied? Most common order, which is getting pretty specific.
Yeah, so that was getting back to the complexity questions.
Right. So if you
had the 3-pool system.
Yeah, so I can give you an example. We have a client today. We were just talking. My partners. We have a business lunch every day, every Wednesday, and we were talking about a client we just picked up, and the CPA that was handling them had them with a fringe overhead and G&A rate, and these guys are computer programmers. And basically, and I'm going to make things overly simplistic, they sit in a square room with the lights off, and there's 4 of them that bang on a keyboard all day. So you couldn't have a simpler business. They do cybersecurity, and there's no materials, there's no subcontractors, there's not a lot of other direct costs. Everything is driven by the 4 guys in the room. So everything is driven by direct labor. So we basically went back to them and said, why do you have such a complex cost recovery system? How about you just have an overhead rate? So when they went back to the government, they proposed with just an overhead rate. Now, as their business develops and maybe they start outsourcing things, maybe they start working on the Air Force base or not, we can bring more complexity in as they grow and it's required. But basically what you're trying to do is come up with the simplest way to share the indirect expenses of running your business with the people who benefit from it. So does that answer your question?
Yeah, that's a fair way to explain that.
Okay, any other questions?
Not off the top of my head.
Okay. Well, it was great talking to you. I wish you the best of luck. All right, let's move on to Alla. Is Alla here? Alla Colton, are you there? Alla, are you there?
Yes, please see what I put in the comment. I cannot talk right now.
Hi, Alla. So Alla's question, I'm going to mute Alla because it sounds like she's probably working and attending the webinar at the same time. It says, are they required to follow government per diem rates even when they are traveling for non-government contracts? So the first question that crosses my mind is, okay, it sounds like somebody's taking a trip. What's the purpose of the trip? So if the purpose of the trip is to visit customer A, then the project should be charged to customer A. If the person taking the trip is visiting customer A and the government is the customer, then the government cares about the travel rate that you charge them. If the person traveling on the project is traveling to a commercial customer, again, the travel charge should be a direct charge to that project. The government won't be reimbursing you for any direct charges on any non-government project. So there's no need to track the unallowable direct costs for commercial travel. However, if you do what a lot of my clients do, which is travel for general business purposes, and you may visit several clients in the trip may have several purposes, that travel expense may wind up as an indirect expense. When it becomes an indirect expense, you are asking the federal government to pay their proportional share of that travel cost. Therefore, you have to screen it for the allowability standards. So if it's a direct cost to the government or an indirect cost to the government, if you're asking the government to reimburse you in any way, you must scan through it for the per diem. The government has per diem charts that they basically allow for travel. So if I'm traveling to Albuquerque, New Mexico, it's cheaper than if I travel to San Francisco, as an example. So the government has per diem, allowable per diem rates that are maximum amounts that you can charge them for travel for certain areas. So hopefully that answers Ala's question. Let's see, Jennifer Murata, are you there? Jennifer has her hand up. But I don't hear Jennifer. So Jennifer had a question that says, can a company have only one indirect cost rate each fiscal year? The answer to that question is, oh God, Jennifer, I hope so. One of the biggest mistakes I see people make is using different indirect rates for different proposals. The correct way to do this is to basically sit down once a year and try to project what you think the appropriate indirect rate is going to be. As things structurally change in your business, you may need to revisit that exercise, but at a minimum, once a year, you should be projecting your indirect expenses, and those are the indirect rates that you should use when you propose on government contracts and grants. So when you say, can I have only one indirect cost rate each year? The answer is yes. Now, what trips most people up is, oh, I was writing a proposal for DOD and they asked me what my fringe overhead and G&A rate was, so I used numbers that I thought made sense then. And then I went and I wrote a proposal for NIH, and they asked me what my fringe and F&A rate was, so I came up with a different set of numbers, and I used those in that proposal. So when I pick up a new client that has that sort of situation, I ask them, which job are you going to hemorrhage the most money on? Because you can only have one indirect rate at the end of the year, and you've got to apply it to all of your projects, regardless of how you propose them. So it's an incredibly dangerous thing to do, to use different indirect rates for different customers. You come up with one indirect rate methodology, the one that works best for your business, and when you're filling out the cost portion of the proposal for the government, if their format doesn't fit your indirect rate methodology, you put a little asterisk there, you drop the big number in there, and you say, please feel free to call me, and I'll be glad to share my indirect rate projections with you. But do not start making up different indirect rates for different customers and different agencies. That's a recipe for a cash flow disaster. Hopefully that answers Jennifer's question. I've got time for one last question, and that is Dean. Let's see if Dean is there. Dean, are you there? Dean, are you there? I've got a lot of noise from Dean. Dean asks how to allocate costs when grants have significantly different indirect rates. Dean, based on my answer to the prior question, I'm incredibly concerned about your question. I'm sorry we didn't get a chance to connect. But I am happy if, just based on your question, I'm happy to extend a free risk and compliance analysis for your company. I'm just concerned that you're probably not doing things correctly if you're using multiple cost structures on different government programs. So I see we're out of time. I unfortunately didn't get a chance to talk to everybody on my list. But if you've got any questions, please feel free to call Katie Crowley. She's very capable of grabbing anybody in the office to help you. I look forward to seeing you all at the National SBIR conference if you're going to be there. And I wish you a great day and talk to you soon. Thanks.